America, it's a great country, but we have problems. We look to our government for answers to these problems. The biggest problem that America faces today is the instability and the inefficiency of our economy. But what's the right way to guide the economy? What's the best way to stimulate the market without undermining the basic tenets of free enterprise and the basic ideals of a free market? I have an originally designed plan that you will not have heard anywhere else on how to fix our employment problem. I believe in giving people the bottom line up front. My plan consists of two parts. Number one, re-engineer the corporate tax system to be employment sensitive. And two, make employment credits tradable. Tradable. All right, we'll explain this after we explain step one. Let's talk about corporate taxes, okay? As far as I'm concerned, corporate taxes only have value in terms of what they are able to incentivize. Now, when it comes to the question of corporate tax reform, normally you have people on two sides, okay, saying either one, corporate taxes need to be completely cut out, they need to be abolished, and that would be best for the economy. And then on the other side, you have the people saying, well, if you cut taxes, then really what you're going to be doing is you're going to be cutting taxes on some of these big corporations that don't intend to employ any new people anyways, but what you'll be doing is you'll be increasing their profit margins. The reason that we aren't really able to move forward on this issue is because we are approaching tax reform in a very static manner, okay? We're looking at, okay, should we increase the tax rate for corporations, or should we decrease the tax rate for corporations, or should we keep it the same? Nobody's talking about how can we re-engineer corporate tax to do better for our economy, to incentivize the kind of behavior, the kind of decisions that are beneficial for the economy as a whole. Now, as I said when I was explaining the two parts of my plan, I believe that the corporate tax code, the corporate tax rate, should be employment sensitive. The more people that are employed, the less people who are unemployed and relying on government assistance. The more people who are employed, the more people who are paying taxes and increasing government revenue. And lastly, the more people who are employed, the more people have to spend into the economy. In our economy, all companies are different. So if we give $1 million of tax credit to one company, it might end up in reaping more jobs created than $1 million given to another company. To illustrate this point, I'm going to speak about what I call the profit elasticity of employment. So what we have here is we have two different graphs. We have graph A and graph B. These represent two different companies, okay? Let's imagine right now that the profit that each company is receiving is sitting right here at this height. On also each of these graphs, you can see the vertical axis stands for profit and the horizontal axis stands for employment. Okay. Now, as I just mentioned, as a company's revenues or profits increase, the number of people they employ and how much they pay them is going to change via the business model that they use and the decisions that they make. So what we see here is we see the relationship between profits and employment for both of these two companies. So here, if both companies start off at the same level of profit, then this company right here is going to create this much employment, right? And this company right here is going to produce this much employment. Okay? Now, the key thing here to understand about profit elasticity of employment is that as we increase the profits that are gained by a company. The question is, how far is that going to push out employment? For sake of making the point, let's say we triple the profits here of company A from this level right here up to right here. So what this distance right here represents is how much the profits have increased, and what this distance, you can see here, what this distance represents is the amount that employment has increased. And you can see that employment has increased at a greater percentage than has profits, okay? That's because of the angle that this relationship takes, all right? Now let's look over here, okay? So we're going to do the same thing. We're going to triple the profits, and we see that we have the same increase of profits, but we see that we have a very different increase here in employment. So we started out with two companies that made the same in profits, and then we made an increase in the profits, but what we see is a very different relationship between profits and employment between the two companies. So what I would say here is that in this example, employment is profit inelastic in this example, and in this example, employment is profit elastic. Now, keeping this in mind, the question I pose to you is, which of these two companies would we want to give a tax break to? For our money to go the furthest towards the objective of creating jobs, which one would we want to give the tax break to? Okay, clearly, easily, we would want to give the tax break, if we were to have to choose, we would want to give the tax break to company A, because we get a much bigger bang for our buck than here. Really, by giving these guys a tax break, we're increasing their employment slightly, but what we're really doing more than anything is we're increasing their profits, okay? So the point here to understand is that all companies will have a different response and a different sensitivity to their profits being increased. And right now in our tax system, this difference in companies, company sensitivity, company reaction, this difference is not accounted for in our tax system. Here we have the same two companies, company A and company B. All right. Now these rectangles represent the proportion of their discretionary income, if you want to call it that, that they devote either towards profits or towards employment. A choice that every firm can make is how much money do we want to reap as our profits and how much do we want to expend towards employment. Employment compensation, just to be clear, can include salaries, can include bonuses, can include health insurance. All these things are considered employment compensation. Now with this example, with company A, we see that profits are much smaller as compared to total employment investment, right here. Then with company B, we see that profits are much larger than total employment investment. Now, in reality, so you know, these ratios are not exaggerations, okay? There are companies that make a very small degree of profit versus the amount of employment. In fact, I think we all know that there are some companies who are intending to make profits who aren't making any profits versus the employment that they're invested in. But they're trying to grow. Okay. One example of a company that has a relatively low amount of profits per employment would be Bank of America. And now clearly Bank of America is a bank. They don't have a low ratio as far as this goes because they don't want to make more profits. It's just because they were hit really hard by the whole banking and financial crisis. And so eventually that ratio is going to change. But that's one example. Okay. Now over here, company B, where you have a much higher degree of profits than employment compensation. An example of that would be ExxonMobil. Okay, ExxonMobil, to speak roughly, reaps about 10 times as many profits as they expend in employment benefits. We can look at this proportion two different ways, and I created a name for them: the diffusion ratio and the concentration ratio. Okay, so the diffusion ratio is kind of the good metric. Okay, how the larger that number, the better a company is for larger society, as far as those raw numbers go. And so we can see diffusion ratio equals employment divided by profits. And when we say profits, we mean profits before taxes, so it might be considered operating income. We can specify exactly what that means a little better as time goes on, but right now we're working with big ideas, so just bear with me. Okay, secondly, we have concentration ratio. All right, so concentration ratio is profits over employment. If the concentration ratio is very high, that means that they have a very high degree of profits per employment investment. Okay, so in our example right here between Company A and Company B, Company A would have a very high diffusion ratio, Company B would have a very low diffusion ratio, and when it comes to the concentration ratio, Company A would have a very low concentration ratio, and Company B would have a very high concentration ratio. So I'm going to ask the question again. All right, let's say we have to decide between these two companies. All right, we're going to give one of these two companies a 30% tax rate and the other company a 10% tax rate. Which one would we allocate the lower tax rate to in order for it to be most beneficial to the economy? We want to do it for this rather than this. Okay, because what happens is you have more efficient and more effective diffusion into the rest of the economy. Okay, more people being paid a reasonable salary, more people investing in their local economies, etc., etc. But let's imagine for a second that we reverse the roles. Okay, imagine that we charge Company A a very high tax rate, and we charge Company B a very, very low tax rate. What is going to happen? What's going to happen is investors, people who are investing in this company, are going to reap very positive gains. And who are these investors? Who do these investors normally tend to be? And investors in this company are going to reap lower gains. But who are investors, generally speaking? Yes, a free market capitalist might say, well, everyone's an investor, because everyone has a retirement plan, etc., etc. No, don't tell me about, $25,000 that some old grandma has in a bank account trying to invest. Who are really reaping the profits from investments going up? And it's the higher income people, okay? And I'm not saying this to villainize them. That's not what this is about. But the question is, one of the dilemmas that our economy is facing right now is a diminishing middle class and an expanding upper class. Okay, we are seeing greater and greater stratification, and we are seeing a gap widen more and more between those who are middle class and those who are upper class. Okay, and this growth, this benefit of the upper class, isn't necessarily bad in itself, so long as it's in proportion with the growth of the rest of the economy. The problem we have right now is it is disproportionate with the growth of the rest of the economy. So we have to look at this and say, okay, what's going to happen? If we give them a big tax break but give them a higher tax burden, what's going to happen is the investors, the upper class people, are going to benefit more, disproportionately more, to the middle class and lower class, especially since the lower class probably doesn't have any stocks in the first place. So this would exacerbate our problem that we have right now, not mitigate or diminish our problem in any way. Okay, I don't claim to be an authority on this matter, but from the research that I've done, I see it to be most beneficial for our economy if we do make the corporate tax rate employment sensitive. And how are we going to make it employment sensitive? We're going to use these ratios, okay? And you can choose either one, okay? for the time being, we'll remember the diffusion ratio as the good ratio, but right now we're going to focus on the concentration ratio, okay? So the idea is, the higher a company's concentration ratio, the higher we are going to tax them. Think about it as income tax, okay? In the world of income tax, we use a progressive tax rate, okay? So the people at higher incomes are taxed more, all right, in terms of percent, right? The people on the upper end of the tax scale might say that that's unfair, but in my life, I have learned that it is easier to make money when you have money, okay? When you don't have money, it is extremely difficult to get by and to progress in society. The overall idea behind taxing the rich more is that they can afford to be taxed more because they have more discretionary income. Likewise, if we take that as an analogy back to this, back to the scenario of business, okay? So we look at this company, and the amount that they're able to reap for profits is very small. And because it's small, it means that they don't have nearly so much discretionary income to work with. All right, they're barely getting by. Okay, they're barely making ends meet. Okay, so why would we want to tax them the very same as this gigantic corporation that's reaping huge profits and has huge discretionary income and is not investing very much in employment? If we're going to make the corporate tax system sensitive to employment, and we have to figure out what the concentration ratio of a given company is, one of the problems that we have to tackle first is we have to figure out how much credit we're going to give, or how we're going to define the employment credit that we're going to give to companies based off of how many employees they have and how much they pay their employees. If we only gave companies credit for how many employees they employed, then the people who would, or the companies, the corporations who would benefit the most would be simply the ones with the most employees. Walmart, for example. Walmart has around 2 million employees. As far as I understand, they're the biggest employer in the United States. So just as an example, they would be benefiting most. But there's a dilemma with that. The average salary of employees at Walmart is somewhere around the range of $20,000 to $23,000 a year. Now, to keep things in perspective, minimum wage only comes out to being about $15,000 a year. So the average salary for the Walmart employee is not much over minimum wage. So we have to, in some way, account for how much employees are being paid. Now, on the other hand of the spectrum, if our only metric is, okay, what is the total amount of wages that are being paid to all employees, if that's the only thing we look at, then we run into another problem. Say, for example, you have one firm, I love hedge funds, so I'm just going to keep talking about hedge funds. We have a hedge fund where you have five employees who are each reaping $1 million in compensation. So you have $5 million of compensation being spread out to just 5 people. Let's look at that as compared to $100,000 of compensation being distributed to 50 people. Okay? Which one of these examples would you say is more broadly beneficial to society? Okay? Or we can ask, which one has a higher concentration of capital? Okay? The example clearly where the $5 million is distributed amongst 5 people, that would be the example of a higher concentration of capital and a lower diffusion of capital. Okay? And so if we were to just judge these two companies based off of how much total salary or how much total compensation is being accrued by the employees collectively, we would find that we'd be taxing these two companies equally. So we have to be able to taper off the credit we're giving to companies for a certain level of employment. I have thought about this problem a lot, and I want to present my proposal for how we should give companies credit for employment. Okay, now this specific proposal can be adjusted any kind of way, but I want to lay this out as an initial model which can be refined and optimized later on. Okay, so what I have here is I have a graph of the employment credit function that I would propose personally. Okay, what we see here, the x-axis is the employer's compensation to the employee in thousands of dollars. Okay, so we have 10, 20, 30, 40, 50, 60, 70, 80, on. Okay, and then here on the vertical axis is the amount of employment credit that we are going to allot to the company per employee. Okay, so what we would do is we would look, okay, per employee, what is their compensation, and then we'll go to that level of compensation. We'll find out where on this line the employment credit sits at, and that's how much employment credit the corporation would get for that one employee. So then what happens is this function is run, I do programming, so it's a program for me, but this mathematical formula, which is really very simple, is used to judge the compensation provided to each employee, and then the total employment credit is then added all together and then used as the metric to assess the proportion of employee investment to profit investment. Now, to be clear here, what's going to happen is if you run the math, and again I do programming, so I ran the math with the programming, what you'll find is that companies have a slight incentive to hire employees or to pay employees up to the $60,000 mark, okay? And then as you get past $60,000, clearly you can see it tapers off here. There's a slightly decreased incentive, all right? So what's going to happen is employers are not incentivized to pay their employees less, okay? But at the same time, they're not necessarily incentivized to pay their employees multi-million-dollar wages. So to conclude this segment, in order to calculate the concentration ratio for a given company, we have to have this figured out, okay? And putting some thought into it, this in particular is what I proposed. Now, as a matter of minutia, we could move this middle of the way mark here at 60,000. That could be moved up a little bit, down a little bit. But if you want, that's small time argument. But my overall argument is that the shape of the curve, the shape of the function needs to follow this approximate model. Now that we have a function to calculate exactly how much employment credit we're going to give companies, we can now look at the concentration ratio. We can calculate the concentration ratio to be able to compare companies on an apples-to-apples basis. Okay, so using the particular function that I gave you just a second ago, the concentration ratio would be calculated as total profits in dollars over credits times $6,000. And it's not $60,000, $6,000, because this is where $60,000 equals 100 credits. And again, just to make perfectly clear, what I am making the assumption at is that $60,000 counts as full employment. So one full employment credit would be worth 100 employment credits. Okay, so that's how I have things allotted in my system. That can be changed in more refined systems. But this is just an example. If we were to say, okay, that one company has a concentration ratio of 0.2, then what that would mean is for every $100 that a company makes in profits, they pay more or less $500, so 5 times as much, in order to compensate their employees. Now, if a company had a concentration ratio of 1, that would mean that for every dollar that that company decides to allocate towards profits, they're allocating an equal amount for employee compensation. Now, what if we had a concentration ratio of 10? And before you think that this number is outlandish, just remember that there are many examples of this, whether we're talking about hedge funds, whether we're talking about ExxonMobil's or other high-profit industries. Okay, so a company who has a concentration ratio of 10, that would mean that for every dollar they expend in employee compensation, they reap $10 in profits. So what we have here is we have a continuum, all right? We have a spectrum, all right? We have a spectrum that we can now analyze. And we can say, all right, here's 1. 1 is our middle of the road number, and then anybody who has a concentration ratio of less than 1 is this way. Anyone who has a concentration ratio of more than 1 is this way, okay? So now that we have a single metric to look and adjust and judge companies by, we can then figure out what kind of function we want to use to determine the tax rate as some function of the concentration ratio. So that's the next step we're going to take. The function that I propose we use to determine tax rate is as follows. Tax rate equals 50 times the ratio all over ratio plus 1. Okay? Now, it might seem a little strange, but if you start doing the math, you'll see it's very, very reasonable and makes a lot of sense. Okay, so just as a very small example here, we're going to take 3 different ratios. Again, this is the very low concentration. This is what we would like to consider the more equitable companies. And this is the high profit companies over here with a ratio of 9. And again, as ratios go, we're talking specific. When I just say ratio, I'm referring to concentration ratio at this point, not diffusion ratio. All right, so here, if we plug this into the equation, 8.3% tax rate. All right, not bad, not bad. Okay, that's much lower, considerably lower than our current 35% tax rate. Right? Now, if we have, again, the even middle of the road company here with a ratio of 1, we can plug this in and it's really simple. So these guys are going to pay a tax rate of 25%, which again is less than the going tax rate of 35%. Now we move to the higher income, higher profit companies here with a concentration ratio of 9. Okay. A 45% tax rate. Okay? And 45% may sound like an awful lot, but number one, we need to keep in mind for every $1 they're paying in employment compensation, they're reaping $9 in profit. So it's not that big of a deal. Sorry. But 45%, they can change that, and I'm going to get into that here in the next segment in a second. But they can actually change exactly how much of a percent they pay in taxes, and they can do so in a way that benefits all the other companies. Now, keep something in mind. I think this is the general form that this function should take. But if we want to change, like if you were curious, okay, what is a maximum tax rate that any company would pay? You'll see that the tax rate slowly approaches 50%. Okay, but with this particular function, it will never exceed 50%, and you can do the math on that yourself. But you'll see that the total tax rate will never exceed 50%. So if we wanted to adjust and optimize this function that we're using to be able to calculate the tax rate, we can change this. We can change this down to 40%, and then all of these will be reduced accordingly. You can do that math. Or we can up this to 60% if it happens to be economically advantageous, but I don't suspect it would be. I'd have to do the math on that. I suspect that a maximum of 50% would be pretty equitable looking at the economy as a whole. Now I want to show you how this would affect the tax rates of businesses overall. Okay, so let's say we found out the capital concentration rate, the ratio for all the companies in the S&P 500. Okay, let's say we did that, and then we ordered all the companies according to their ratio. So we had all the companies with a very low ratio on this side, and all the companies with a very high ratio on this side. So again, the companies with a higher rate of capital diffusion would be over here, and the companies with a lower rate of capital diffusion would be over here. In this example, if we ordered them all in a line, then we would want to tax these companies over here more than these companies over here. So I want to show you exactly what that would look like. Here, I have done just that. This is, again, I'm just writing on a whiteboard right now, but this is a fairly accurate depiction of how the tax rates would be represented across businesses. All right, so what I have here at the bottom is this is businesses ordered according to their level of capital concentration, and this is percentile. Okay, so percentile of capital concentration. So you can imagine a whole bunch of little points here, each representing one business. Okay, and then we use the function that we just spoke about to calculate the percentage tax, and you would find that at each one of these points, it would calculate this line right here, this percentage tax. Okay, so here on the vertical axis, we have again the maximum in my example, 50% tax. And then 40, 30, 20, 10. Okay, so when you actually do this math for all the major companies in the U.S. economy, you'll see that the distribution follows something quite like this. So what happens is this dotted line right here actually represents where the tax rate is right now on large corporations. So it's at 35%, okay? So what we can see here is that my proposal, if instituted, and I'm sure it'll be changed one way or another, but my proposal, if instituted, would actually decrease the nominal tax rate of 75% of companies, while increasing the tax rate on only about 25% of companies. Okay, so number one, that is really good because, as I said at the outset, generally speaking, the lower the taxes are on companies, the more they are free, the better they are free to be able to invest in employment and new ventures and growth, et cetera, et cetera. So this is what I'm looking at. This is what I would like to see. But now, how is this beneficial to the economy? This is beneficial to the economy in more than one way. It's not just good because we are on average, and the average tax rate then, if we see this is the current tax rate, the average tax rate of everybody then would say then be about 22%. Okay, if we take everybody, average would be about 22%. So we bring the average tax rate from this static level down here to this level, which would be better for the economy as a whole, number one. But the even more important thing that this does is this creates what is called an environment of continuous incentive. Okay, but, highlight that right there, continuous incentive. All right, this, no matter where you are on this spectrum, you have incentive to be able to either pay your employees more if you're paying them on average less than $60,000. You have incentive to hire more employees. All right, now it's time for step 2. And step 2 is pretty straightforward to explain, okay? Now, imagine these companies up here are crying about their 45% tax rate and say, hey, we contribute a lot to the economy, hey, it's just not represented in our employment credits, okay? All right, number one, I'm not going to cry for them, but I'm going to allow them to help stimulate and boost the rest of the economy in order to make their tax rate lower. How? By making employment credits tradable, transferable. What this means is that each company creates a certain number of employment credits, right? But they are allowed to trade those employment credits at whatever price they are able to come to agreement with another company. So what happens is the companies down here, which are making a very, very good tax rate, they barely have to pay anything on taxes because they have a very high ratio of employment, employment compensation. They do not value their employment credits as much as these companies up here, okay? These companies up here value the employment credits a lot, okay? And so what happens is, if you give these companies an opportunity to buy employment credits from these companies here, what happens is this company will have additional revenue, and this company will essentially be subsidizing jobs in these companies which are more socially beneficial. They create more social benefit, more positive externalities. Okay? This company is voluntarily subsidizing jobs in this company. Okay? And they're doing so because it is advantageous to their overall bottom line, because they're able to bring down their total taxes paid, and the final profits after taxes are actually increased by this trade being made. Okay, now somebody who's skeptical might say, I'm not sure about that. How would that work out with the mathematics? Okay, well, I've done the mathematics. I've created programs, agent-based programs that simulate an economy. Okay, I took the data for 50 different companies across the economy, mainly the biggest companies here in the US, and I looked at the spectrum, and I wanted to find out, okay, what would be, at this price and at this price, at this price, what would be the optimum decision for each one of these companies to make in terms of whether or not to buy or to sell employment credits if they were at these different prices. And what I found was, after you do the math and you set up the program, is that you get a very pretty supply and demand curve. So what can you do after you have a supply and demand curve? You can find the equilibrium. Meaning, I was able to find out in my simulation exactly how much in this model economy one employment credit, or one full employment credit, which is 100 credits in my example, one full employment credit is worth monetarily. So, as an example, in my program, I had found that one employment credit in this model was worth about $13,420. Now, clearly, the model I made is a model, and the actual number that would be produced by a trading the economy, a broader economy bigger than 50 companies would differ, I'm sure, from the metric that I've determined. But the point here is that it would be advantageous for companies to trade. So what you would end up having is that, so this is the distribution of the tax rate before trade. And then after trade, what you'd have is you'd pretty much have a mellowing out of this distribution. You might have the lower end here pay 10 or let's say 12% tax because they've traded away some of their employment credits. And so now they have to pay a higher tax rate. But these companies way up here now pay a much lower tax rate because they have bought a whole ton of employment credits, right? So these guys have been able to successfully decrease their percentage tax, and maybe they even decrease it more. You know, we'd have to see exactly how the numbers come out. But the point is, any company that would complain that they pay a disproportionate amount in taxes would have the ability to decrease their tax rate by the subsidizing of employment compensation. Okay, so the last piece of information that I wanted to give you on this whole idea of transferable employment credits is, let's go back to the example of ExxonMobil, or some of these big oil companies which have very high profits but very low employment compensation. These big companies, these big money companies who want to make the claim that they benefit the overall economy greatly because of their investments. Again, that may have a certain amount of truth to them, but they can essentially put their money where their mouth is, because when these employment credits are transferable, if they make a deal, a multi-million-dollar deal with a contracting company, included in that deal could very well be an agreement that, okay, in order for us to make this contract with you, you will also have to sell us X number of employment credits at Y price. So that way, these big companies who say, hey, we do a lot better for the overall economy than it appears, they are capable to bring in this employment credit from their contractors if it is in fact proportional, if it is in fact that they are creating jobs. So this is really, as far as I'm concerned, a highly effective and highly equitable system. And I really, really, really want to see it come to fruition. So in conclusion, my model, my plan, supports employment 3 different ways. 1, it supports robust compensation through the nature of the function that I use for employment credit. 2, it provides continuous incentive for companies to have a higher and higher percentage of their total discretionary income, revenues, whatever you want to call it, to put it towards employee compensation. And 3, it allows this system, this distribution, to become more optimized through the trade of credits. Okay? So these are the 3 ways that my system supports and boosts employment. If you find this idea in the least bit convincing, I want you to know my objective is to get this idea put forward and to get this idea submitted to Congress in some kind of formal form. Okay, that's what I want to do. I want to go on, I want to write a research paper that shows the results of my programs, my simulations, my models, and try to put forward a legitimate, formal argument for this kind of policy, okay? Because I believe that a stable economy is a strong economy, is a growing economy. And that's what I want to see in America, okay? Because the last thing, as far as I'm concerned, Americans should be worrying about is jobs. We should be going to the moon again. We should be going to Mars. We should, the idea is we should try to be doing greater, bigger, and better things, okay? That's where our focus, our energies, our minds, our consciousness should be. But it can't because of the instability of our economy. So what can you do? You can help me by, 1, spreading the word about this video. Okay? If you agree, if anything I said really strikes a chord with you, please, I need your support. Okay? I am putting this video on the internet in order for the idea to be shared. I may be contacted at ROLFSENplan, one word, @gmail.com.